Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, starting with the gold prices, which have hit an all-time highs to rise above $3,025 an ounce, gaining nearly 15% in this year and holding 40% gains in the past 12 months. And it's not just about gold. While other precious metals, you have silver, which has gained up by 17% in this year till time. This is all supported by weak US dollar index, which is trading at a 5-month lows. And it's not just about precious metal prices, because when you look at the base metals, you have copper prices now trading at near 10-month highs. Aluminum is trading at a 9-month highs, and this is on the back of supply disruptions, strong demand coming in from US, and then you also are seeing support from China's stimulus measures. One part of that already has come in on Sunday over the weekend, and the second part is what the country seems to be pledging at. And then it also is about trade tariffs, which seem to be finding their way in case of many of these metal prices. When it comes to energy, the prices are holding firm, but it really is about Trump's tariffs measures, which are weighing on the sentiment here as well. And then it also has to do with the Chinese demand, which isn't looking really very strong even in 2025 till time. So what really is the road ahead for commodities in 2025? Joining me now to discuss this further is Ole Hansen. He's head of commodity strategy at Saxo Bank. Ole, hi, thank you so much for joining in. And the first question clearly is about gold. We've seen all-time highs multiple times in this year, but now we're looking at $3,000 an ounce and above. In Indian rupees, various other currencies, also gold prices have hit all-time highs. What's your sense now? From where are we headed from here on? There's a correction that the markets believe is long due now. Where do you see prices ranging from this place?
Oh, that's a million-dollar question, isn't it, Manisha? I believe that the travel is still towards higher prices, but I think also this $3,000 level has been such a magnet for a while, so we may need to see some additional deterioration on the economic front in order for the rally to continue. So I wouldn't be surprised to see some consolidation here, perhaps a pullback towards 29.50. But generally, given the uncertainty in the world, maybe perhaps with the exception of a potential for a peace deal in Ukraine, then the overall picture still points to support, and that's why we're still maintaining our outlook for 3,300 for gold later this year.
All right, $29.50 on the lower side, but $3,300 an ounce on the higher side. But all the question really is on where do you see a lot of buying coming in now? At these current levels, I'm assuming a lot of people would not want to get into the market. But with $3,000 an ounce already done, are you looking at central banks buying at this level, or is it going to be ETFs? What kind of investment firms do you see coming in now at these current levels?
Well, the central bank demand remains strong, but just like we've seen before, whenever we've seen a fresh push to the upside, we may just see a bit of a pause while traders and investors get used to these new and higher levels. But what we have noted in the past 3 weeks is that the speculative interest in the futures market, especially in New York, has been fading a little bit, but at the same time, demand for ETFs has been picking up. And I think it is the prospect for, or the risk of stagflation in the US that's driving asset managers back into gold. Some of them have not really been involved in this rally. We saw this big sell-off in ETFs or ETF holdings in the past few years. Only now we're starting to see some of that flow coming back. And if we do get additional confirmation that the US economy is softening, that prices remains, or the inflationary input remains elevated, then I think we could see some additional demand coming from the ETF side. So I'm looking for ETF buyers and central banks to provide the underlying support.
While we do understand with these all-time highs in gold, the overall global gold capital market now is at $20 trillion. Silver not too far behind, because we've seen a good performance here, 17% of gains for silver prices till time in this year. How are you looking at silver prices from here on? I remember our initial conversation and you talked about $40 an ounce as well. Are you sticking to those levels now?
Well, in the short term, a lot really still depends on the tariff uncertainty related to US imports. We've seen the very, very strong rally in copper recently, with the copper price in New York now commanding a 10% premium over London. And that has also helped support silver to move up towards the level you mentioned. So in order for these levels to be maintained, we need to see obviously some clarification on the tariffs. But on top of that, we are seeing a tight silver market this year. Above ground inventory levels are likely to be reduced further due to lack of supply relative to demand. And that basically means that if we can see gold move towards 3,300 and the gold-silver ratio move back down towards the lows from last year, then I wouldn't rule out that we could see silver move up towards $44.
$44 an ounce for silver. Well, okay. While we are talking about metals already, Ole, what's your sense on the other metals now, the base metal prices? You spoke about copper right now, and you're expecting prices to move higher onto this side as well. So when you look at copper prices, it's trading at a 9 or a 10-month highs. The potential tariff threats on many of these metal prices have actually taken metal prices higher in US than where they are on LME, on China for that matter. How would you look at an overall impact in prices? Let's start with copper first.
Well, we do not really expect any impact on gold. I would be very surprised if that happened. Then the silver market is pricing in tariffs at this point, not to the extent that we're seeing in copper, where the market is obviously worried that it will be the same level as aluminium and steel, i.e. 25%, which means that the spread between the two would widen even further. But what we have to remember that this exercise we're seeing right now is shipping metals from around the world, both copper and silver, to the US market. And that means that we're seeing some of this metal eventually become stranded in the US, waiting for a consumer to pick it up. And that basically means the rest of the world will start to be drained. And we're seeing that already in the copper market, but potentially also in silver. So even though we're not getting any tariff introduction just yet, it is hoovering the global market for metals, which will help tighten the global market and thereby underpinning prices.
How are you looking at the aluminum prices going forward? I mean, as you mentioned, we've seen US markets trade at a premium at this point and time, and that has been the case with steel as well. Do you see this continuing? Do you see the arbitrage opportunity go away at some point in time in the first half of this year?
Well, now that the tariff has been implemented and we know what kind of spread level that there needs to be in between the two markets, then some of that arbitrage activity will probably start to fade. But it doesn't really remove the fact that the US aluminium production, which is obviously the whole idea about this exercise, to force producers to produce more aluminium within the US. That is not going to happen anytime soon. We had a comment recently from, I think, the aluminium board or whatever it's called, that they cannot see any sizable pickup in US aluminium production for at least 5 years, also because of the very energy-intensive process this refining is. So that basically just means that it boils down to higher prices for US consumers in the foreseeable future.
How are you also looking at the energy markets? And this is the area where we've seen tariffs that have been talked about in sense of remuneration. We've seen Chinese demand being not so strong as well. And then there's been a constant decline in crude oil prices. We've seen last 2 years in negative. This is a third straight year where we are trading in the negative for the crude oil prices. How are you looking at a slightly longer term scenario? Let's say until the end of this year, how do you look at the crude prices?
I'm actually fairly constructive, not outright bullish, because obviously we are still facing the risk of a global economic downturn. But the fact that we come down to the low 70s, and the fact that there is a risk that if we drop even further, we could see some production start to be curtailed, I think it's enough at this point in time to support prices near levels where we have reached recently. I think it's also worth remembering that the reintroduction or tightening of sanctions against Iran and potentially Venezuela as well could have a much bigger impact than the OPEC Plus announced increases in production. There we're talking about a few 100,000 barrels on a monthly basis, but we have to remember Iran and Venezuela in the last 4 years have managed to increase production by 1.6 million barrels. So that could have a bigger price supportive impact. So I think we are near the lows here in the oil market, simply because the supply side will start to negatively be impacted by even lower prices from here.
Ole, I also want to talk about the dollar index with you, because when we started this year, we were trading at 110, 111 kind of levels. From there, we're trading at a 5-month lows for the dollar index at 103.5 or therefore. Are we done all the bad news in the dollar index, or do you see further decline?
It really depends on whether we continue to see this rotation out of US stocks. There's been quite a lot of that in the past few weeks or past months, I would say. we're seeing this massive spending boom that is going to unfold now in Europe. It makes quite a few companies in Europe very attractive from profitability perspective, and also it just raised the focus on the U.S. tech sector, whether these valuations can be sustained. So if we are continue to see a flow out of U.S. into other markets, it could be Asia as well, then the dollar is likely to suffer further losses. So in the short term, I think especially something like the euro, we could still see the dollar weaken further, and it's all to do about investment flows, which seems to be moving away from the US after we've been moving towards the US for a number of years.
Well, I also want to get a sense on the agriculture as a sector, and we've talked about tariffs, we have talked about US and China and India and US as well. Also, reciprocal tariffs could be coming in from 2nd of April, and that really seems to be hanging like a sword there. How are you looking at agriculture commodities as a segment?
Well, I think it all depends on the coming growing season and crop season. It looks like there was a few movements especially in the U.S. markets, which are going to be the most impacted if the Chinese buyers move their purchase somewhere else. But generally, the movement so far has been relatively benign. So we really need to wait to see how the current season unfolds. We're coming out of a crop year with ample supplies, even though they have been lowered a bit in recent months. But the coming months really will send a strong signal to the market whether these low prices we saw last year was the low if you look at the key crops, and we can find some support from here. And then a market which I know is also very much looked upon in China, the sugar market, has really been through a massive roller coaster in recent weeks. Not sure how much that relates to tariffs, but it really is quite a volatile market for now.
Oh, it sure is, and weather is yet another uncertainty that the markets will have to deal with. But Ole, thank you so much for joining in. Well, that is the view coming in from Saxo Bank, that the gold prices are headed much higher, $3,300 an ounce for gold, $44 an ounce for silver, and further gains in copper and aluminum are in place for the rest of this year. Well, that's about commodities, but coming up after this very short break is Mother Dairy's MD Manish Gupta, who will join us as they celebrate 50 years. We speak to the firm's top boss to discuss the firm's growth blueprint. Coming from